And because price instability, fake price drops, and speculative investor flushouts have made regular investors panic, some people have thought that this volatility was the top of the precious metals market, but people who are calling the top either don't know about or missed the sign that told us the drop in prices in October and November 2024 would only be temporary. Central banks bought the most gold in 2024 in October, taking advantage of last year's weak prices. They are now back at it as the usual suspects continue to rebalance their reserves by selling US dollars in favor of gold. Yesterday, we heard that 2 more countries were joining the party, with South Korea's central bank saying they are looking at buying more gold for their reserves for the first time since 2013. Based on the latest news, what the Fed has done, and what Jerome Powell said in his recent speech, which I just finished watching, I want to talk about how the latest rate cut has changed the path of gold and silver prices. I will then show you all the growing body of evidence that says metals prices can still realistically double from here. Finally, I will give you an update on mining stocks, explain why I think they have been drastically oversold, and explain what I'm doing with my portfolio as a result. Before we start, I want to let you all know that this bonus midweek video was made possible by investing.com and their great market analysis tool, Investing Pro. I use it to keep track of my own mining stock portfolio because it's so easy to use and gives a very clear analysis, ratings, breakdowns, and price targets for stocks across all sectors that even people who are new to mining stocks will find easy to understand. It's even better if you have access to the Warrant AI tool. Unlike other popular AIs like Grok and ChatGPT, it gives you clear financial answers based on real-life data to help you make the best decisions in this profitable but risky sector. Please sign up for investing.com's Investing Pro package if you want to improve your investing strategy, or just check what your favorite YouTubers are saying when they talk about mining stocks or give you price targets. Also remember that if you use my link, which is in the video description, and the pinned comment below, you'll get an extra 15% off. If you want to buy mining stocks now, don't wait, because you shouldn't be doing it blind. And this tool is like a pair of glasses that helps you see things clearly. Before you get too excited about the idea that we've reached the market's peak like in 1980 or 2011, you should know that the main difference between those peaks and now is that interest rates have already reached their lowest point. This is why I keep saying that we are still in the early stages of the metals bull market. So I think the recent price drops for gold and silver were more like short-term temporary pullbacks, like the ones we saw in mid-1973, the first half of 1977, and 2006, which led to much higher highs than long-term market tops. This is because, besides lower interest rates and the soon-to-be return of real negative interest rates, we don't need complicated models or technical analysis to know that gold and silver are still going up a lot. And it all starts with the US national debt, which just hit $38 trillion. As I've said in other videos, this number is likely to rise to $50 trillion by 2030. After that, when Social Security runs out of money in 2033, as the Congressional Budget Office predicts, the debt will likely rise to $100 trillion, then $200 trillion, and finally reach Venezuela on its way to Zimbabwe, since the 4 biggest spending items in the US budget equal the amount of money the country brings in taxes. Therefore, if the current trends in AI continue, that is, if more and more tax-paying jobs are replaced by non-tax-paying AI, as we've recently seen at Amazon, Microsoft, and other companies, tax revenues aren't likely to grow very much, which could make the budget deficit in the US government much bigger than it is now. That will make the US more reliant on lenders to fund its operations, which is a problem because, as I said at the beginning of the video, central banks around the world are actively rebalancing their reserves. They are selling US dollars in the form of US Treasury bonds that central banks have traditionally held to earn interest on their US dollar reserves in favor of buying and holding gold, even though it doesn't earn any return. Moreover, this problem becomes twice as big for US debt because some investment experts are beginning to suggest a 60-20-20 portfolio to their clients. This would split the usual 40% bond allocation of a portfolio in half, with half going to gold and the other half to US bonds. Also, keep in mind that this process hasn't even begun yet, but it will finally move trillions of dollars more into gold and out of US treasuries. As the US's spending rises, its tax base stays the same, and its lenders run out, interest rates will have to go up because the lenders who are still around will want more in return for their dollars, which are losing value. And we got a sneak peek of that today when the interest rate on a 10-year US government bond went up, even though the Federal Reserve lowered their goal rate. And since we know that the US can't afford the current interest rates, which is why the Federal Reserve is under so much pressure to lower rates, this suggests that we may not be too far away from a return to quantitative easing. This is because the Federal Reserve will have to print money to buy US bonds in order to keep borrowing rates low and make up for the lending gaps left by money leaving the country to buy gold. And the Federal Reserve's decision today to end their quantitative tightening program, or balance sheet runoff, as this CNBC headline puts it, is just a step toward the next step, which is to change direction and start easing or printing money again. And shockingly, and I think this is what shocked me the most, the prices of gold and silver haven't really reacted to this yet the way they should have, but they will, for the reason that Jerome Powell said in his speech today, that what I just said is the plan the Federal Reserve is going with. The first thing he said was that the Federal Reserve would be rebalancing their stocks by moving money from mortgage-backed securities to U.S. Treasuries. Afterwards, he said that they would begin to grow the balance sheet once more in 2026, which is another way of saying that they will print money. Additionally, he explained that the Federal Reserve was planning to print more money, more quantitative easing, in 2026 because it was needed to reflect the growing size of the U.S. economy. I don't agree with this at all because most of the nominal growth we've seen since 2020 has been caused by inflation. Because there hasn't been real growth, gold is worth about $4,000 an ounce right now. But that's also why the price of gold and silver is going up. This is going to make people lose faith in the US dollar and US debt. This will justify the return to net gold buying that central banks around the world started doing in 2010 after the global financial crisis and the start of quantitative easing in late 2008 and early 2009. According to this chart from top-down charts, it will push investors who haven't joined the gold bull market yet back to gold and silver. You don't need to know anything about technical analysis, statistics, or advanced math to see that this is the way things are going right now. And to answer your question about why the title of this video isn't clickbait, it's because the Federal Reserve and the US Treasury are continuing down a dangerous path by pushing people out of US dollars and into gold and other hard assets. As I said before, this is just the beginning of this movement.